Good evening, all the joinees. Hi, this is Ansu. I welcome you all to the webinar conducted by NGEN Research. By the time the others join in, let's have a look at today's webinar topic. So today we would be focusing upon how we could create in a portfolio, meaning how we can create a portfolio using the NGEN Fund Score as a filter parameter for creating the portfolio. Post which we would be looking upon various parameters by which you could analyze this portfolio. We would be touching upon the performance of the portfolio against the benchmark, the automatic benchmarking that happens on the platform. Followed by that, we would be touching upon the asset allocation. What is the total exposure that is there towards this portfolio that we create? Followed by the contribution analysis, which would let us know how each scheme in the portfolio would individually contribute to generate portfolio return as a whole. And finally, we would be touching upon the scenario analysis, which mainly lets us create scenarios of our own and see how does the portfolio perform against that of the benchmark. Finally, the last topic would be how you could generate actionable proposals. Firstly, I would be showing upon the reporting options for this portfolio and how a fresh actionable proposal could be created and shared across with the clients. And lastly, the quorum would be open for a Q&A session. You can either unmute yourself or type down your questions in the chat box. So let us begin. So this is the landing page. The Markets tab happens to be the landing page on NGEN Markets. Now, before creating the model portfolio, let's understand what does NGEN Fund Score stands for. For that, let's say I search for a specific fund and load in a new tab. So I've searched in the name right here. There's an option to search funds as well as to search stocks. I've searched Motilal Oswal right here. Next to the name of this mid-cap fund, you could see in a black tile mentioned as NGEN Fund Score. If you click on that black tile, it gives you detailed explanation stating what this NGEN Fund Score stands for. So this is a scoring mechanism on our platform wherein scores are allocated to each fund within the category, and this ranges from 0 to 10. And it is suggested that more closer it is to 10, the better is the performance of that specific fund in that specific category. Now, how do we arrive at this fund score that you could see for each of the fund? So right here, there are two quantitative parameters and one qualitative parameters. So the two quantitative parameters are mentioned right here, AUM and short, medium, and long-term returns and volatility. Now, what is the combinations for these is basically 10% weightage is given to the AUM of the fund, and the remaining 90% is distributed between short, medium, and long-term returns and volatility. You could say, meaning the Sharpe ratio. Now, short is equivalent to 1 year, medium is equivalent to 3 year, and long is equivalent to 5 years. Now, these are the three parameters that you could see. Now, the weightage is equally distributed. Out of the 90%, 30% weightage goes to the short term returns and volatility, 30 goes to the medium, and the remaining 30 goes to the long term returns and volatility. Now, these were the two quantitative parameters. As I mentioned, there is also one qualitative parameter, which happens to be the age of the fund, meaning a younger fund would have comparatively lesser fund score when you compare it to that of an older fund. Basically, because it hasn't proven its performance in the market. It hasn't experienced the swing or movements of the market as much that has been experienced by an older fund. Now, as soon as this younger fund crosses this age of 5 years, it would come at a common parameter or a common scoring with that of an older fund, because the time duration that we consider the maximum is 5 years. As I mentioned, for long, it considers 5 years. As soon as the youngest fund would cover a time of 5 years, it would come at a common level with that of an older fund. Now, another important factor for this NGEN Fund Score is basically that these fund scores are comparable within the category only, meaning you cannot compare the fund score of a large cap fund with that of a mid cap fund or any other category fund. These are intra category comparison only. Now, in this category of mid cap, we could see the best fund score is with that of Motilal Oswal to an extent of 8.36%. And also, these fund scores changes on a month-on-month basis. These scores are given to each fund on a month-on-month basis. These are the latest fund scores as on 30th June 2024. Now, this was the explanation of the fund score. Now we create a portfolio based out of this fund score. For that, I go to this funds tab. So in the funds tab, we have this screener section, which shows you list of all the mutual funds that are currently trading in the market. Now we have this filter categories as an option. You simply click on that and four buckets show up. So these are basically the asset classes. These are SEBI classifications that you could see. And at a given point of time, you could select in multiple categories from these lists. Let's say for now, I select focused fund. Next, I'll select multi-cap funds. Followed by that, I'll select the mid-cap funds. And from the sectoral section, I'll select sectoral FMCG. From the debt section, I'll select medium duration fund. And from the hybrid, I'll select aggressive hybrid funds. So I've selected 6 of these categories. And now I'll click on this X button. Now the entire list without any filtering would come up, meaning the entire list of all these categories would come up. I'll just increase the number of funds that could be seen on the screen to 200. So you could see this comes to be a total of 140 funds based on these 6 categories. Now, let's say you rather want to shorten this list using basic filter parameters that are mentioned right here. So let's say I'll use this minimum AUM as a filter parameter. I'll input 2,500 and minimum age as the second filter parameter as 5. Now, this says that I want to see only those funds whose minimum AUM is 2,500 crore and above, and whose minimum age is 5. Meaning, I do not want to see very, very young funds. I want to see only those funds which have completed 5 years of age. Once you input any of the filter parameter in this section, you need to make sure that you hit on this apply button. Only then the data would get effect. So you see this list has now rather gotten shorted. From 140, we've directly reached to a list of 55 odd funds. You also have an option to use this filter AMC. You simply click on this and you can select any of the AMC that you rather want to select the funds from. Currently, I am not selecting any of the AMC. I'm just clicking upon all, or rather want to view all these AMC's funds. Now, this is the NGEN Fund Score. I'll select the funds just by clicking on this compare icon and take them to this compare tab, which is the tab just below the funds tab. Now, based on NGEN Fund Score, I see SBI Magnum Medium Duration Fund from this medium duration category is the best performing fund. I'll simply click on this compare icon. The second category is this focused fund. And within this category, the best performing fund based on NGEN Fund Score is HDFC Focused 30 Fund. I've clicked on the compare tab and it will get moved to the compare section. Next, out of this mid-cap category, there is this Motilal Oswal mid-cap. So as of now, I have taken 3 funds from 3 categories. Followed by, we have this aggressive hybrid. In this category, I through equity and debt fund is the best performing. I'll simply click on this compare icon. So I've selected 4 of the category. Next, being this sectoral FMCG, I'll select Mirai Asset, which is the best performing in that specific sector. Followed by this multi-cap. Multi-cap, the best performing fund is Nippon India Multi-Cap. So I've selected 6 of these funds. From each category, I have selected each fund. Then I move to the compare tab. So you could see just by clicking on the compare icon, these have rather gotten moved to the compare section. Now, before creating this into a portfolio, I'll just rather have a quick look at the overlaps of each of these funds, basically to see the underlyings are not exceeding a certain limit. So for that, you simply go to the positions overlap tab. So this tab basically lets you see what are the common holdings between every two funds that is there in the main list. So here we have also given in color coordination. So 0 to 20 is light green and 20 to 40 is dark green. So it is rather said that if it is within this green tab, the overlap is within the limit. Within 40% is better. As soon as it crosses 40%, meaning as soon as it takes up this darker tile, yellow, dark pink, and dark red, as soon as it crosses this 40%, decision needs to be taken to keep either of the two funds. If not, it could impact the entire portfolio depending upon the underlyings as well. Now, quickly, I'll just let you know what does this specific section that you see mean. So here you see 21 is something that has been mentioned. I'll simply click on that. And this lets you see what is the common underlying between Nippon Multicap Fund and HDFC Focus 30 Fund. So this shows you the list of entire funds that are common between these two funds. So let's say for the very first stock, that is HDFC Bank. Nippon has HDFC Bank to an extent of 6.5% of its AUM, and HDFC Focus 30 has HDFC Bank to an extent of 9.7% of its AUM. Now, out of these two, we take in the minimum common overlap in this overlap column. And that is what has been mentioned. And once you add up this overlap column, accumulation of this overlap column comes to be a total of 21%. And that is what has been mentioned right here. Now, for this list of funds that I have taken in, the overlap is well within the limit, meaning it has reached only this darker green section. So I'm rather satisfied with this model. And what you could do is simply convert this into a portfolio. We have this option called convert to portfolio. Just by a click, instantly your equally allocated portfolio would get saved. So for that, how could you view it? You simply go to the portfolios tab. You collapse this entire table. Since this was created from the compare tab, it will be available in from compare. So this from compare time and date is something that you could view as well. And anytime you could change its name as well. You simply click on the drop down and you simply click on rename. Let's say I label this as model MF portfolio and click enter. So the new name has gotten saved right here. Next, how you would run this portfolio, simply click on this arrow icon and click on run. Right. So as I mentioned, since this has been created from the compare tab, this is an equally allocated portfolio. You could see the weightage of each scheme in my portfolio is to an extent of 16.67%. Now, since this was created from compare section, this is how the allocation comes up. But anytime you could click on this edit and save as an option and change the allocations manually. You can anytime change them accordingly and click on update. So the updated allocations would take place. As of now, I'm not changing any allocation. I'm keeping it as an equally allocated portfolio. So I'll simply click on cancel. So this is our equally allocated portfolio. You could see here start and end date as an option. You simply click on change and you could change the time duration that you want to analyze this portfolio for. Let's say you want to analyze for this last 5 years ago. You simply click on 5 years ago. The start date gets picked up as 16th July 2019 as a 5 year ago date. Next to that, as I mentioned, what do you mean by auto benchmarking is this thing. Benchmark, next to that, you could see reference index 3. So this is what we call as auto benchmarking that happens on the platform. Now, what is reference index 3? You simply click search reference indices right here. And it says it is 80% Nifty TRI and 20% CISL bond. Now, this auto benchmarking happens based on the asset allocation of the entire portfolio. So I'll come to this asset allocation tab. Here you could see the split in terms of equity and debt. Based on this split, the platform suggests a nearest reference index, which is currently reference index 3. This is what the platform is suggesting. You could go forward with any other reference index. For that matter, let's say you want to benchmark it against a broad-based index like Nifty 500. You simply go to the NSE tab and click Nifty 500. So the benchmark gets changed just by a click. And then you could go to the performance tab and see how the portfolio is performing against Nifty 500 as a benchmark that you just selected. Now I'll just keep it to what it was originally, which is reference index 3. Next, I go to the asset allocation. So this is basically the split in terms of equity and debt. And next to that, you could see the total exposure that is there towards your portfolio. So next to ICICI Bank, you could see an exposure to an extent of 3.34%. Now you want to see where does this exposure comes from? Simply click on this I button. So this says that there are these three schemes that are a part of my portfolio and they have held ICICI Bank as a stock. And that is the reason my portfolio as a whole is getting an exposure from this specific stock. And on our platform, we show in total exposures, meaning very minuscule exposures is something that we show as well. Right here, you could see 0.06% level of exposure. You could click on the I button and see where does that exposure come from. Followed by the concentration tab, which lets you see the split in terms of large, mid, and small cap. The equity market split is what you could see. Now, if you go to this overview tab, we saw the equity percentage comes to be a total of 75.14. Now, this equity gets split into large, mid, and small cap. Now, if you just add this 18 plus 13 and 43, that would come up to that 75.14%. And this others that you could see, everything other than equity, meaning debt, cash, others, if there were any mutual fund as a bar graph, that would come up in this others as a pie section. Followed by that, we have this equity sector, which lets you see which is the top 10 equity sector that has exposure towards your portfolio. Currently, for this portfolio, banks as a sector has the highest level of exposure to an extent of 11.73. Now, you could simply click on the bar graph and it lets you see currently in IT software as a sector, these all are the stocks that have exposure towards my portfolio. And the percentage of exposure is something that could be seen just besides it. Followed by that, we come to the performance tab. So this tab lets you see how does the portfolio perform against that of the benchmark, which is currently reference index 3. Now, in a graphical manner, in this line chart, we could see that the blue line is the performance of my portfolio and the black line is the performance of the benchmark. So in a graphical representation, we could see that there is an outperformance by this portfolio that I created. Now, we could also see this in numerical terms right here. Cumulative return, which is basically the point-to-point return for this portfolio. So the portfolio cumulative return comes to be a total of 170%, while the benchmark return comes to be a total of 107%. Followed by that, if you want to see what is the risk that was undertaken, you could simply come to this annual volatility as a tab. So this says what is the risk that was undertaken by both the portfolio and the benchmark in the given time period. So it says that the portfolio took a risk of 13%, while the benchmark took a risk of 15%. So you could say the portfolio generated a better return with a lower level of risk in this time duration of 5 years that we have set in. And that could also be seen in terms of its Sharpe ratio, which basically lets you see the risk adjusted return, which is 0.99 for the portfolio and 0.57 for the benchmark. Higher is that for the portfolio. Followed by this, we could see cumulative excess on benchmark, which basically lets you see the alpha excess generated. This is basically achieved. 62.96 is basically achieved by subtracting 107 from 170. That is the excess that has been generated over the benchmark. Followed by that, we could see the capture ratios. So these let us see how does the portfolio perform when the benchmark was in a bull run or in a bear run. Specifically talking about up capture ratio, this lets us see how did the portfolio perform when the benchmark was in a bull run. So next to the percent, you could see an I button. If you simply click on that, you could see that here in the up capture ratio, we consider only those months when the benchmark generated a positive return, irrespective of whether the portfolio generated a positive or a negative return, because we give in consideration to the benchmark returns in the up capture ratio, which are only positive. Once we have all these months, we take a CAGR of this data set. So that comes up to be 51 for the portfolio and 46 for the benchmark. Now, just by looking at this data, you could see that when the benchmark was in a bull run, my benchmark moved up by a 46%, while my portfolio moved up by a total of 51%, meaning it says that your portfolio did have the ability to beat the benchmark when the benchmark was in a bull run. And how did we arrive at this 111%? You simply divide the returns of the portfolio with that of the benchmark, meaning 51 divided by 46, you reach this 111%. And we say higher the up capture ratio, better is the ability of the portfolio to beat the benchmark. And by higher, we mean more than 100 because we consider the benchmark to be at 100. And similarly, converse is the down capture ratio, which lets us see how did the portfolio perform when the benchmark was in a bear run, basically letting us see the resilience of your portfolio. Now here I'll click on the I button, and here we will consider only those months when the benchmark generated a negative return, irrespective whether the portfolio generated a positive or a negative return. For example, right here in the month of Jan 2020, the benchmark generated a negative 1.17% return, while the portfolio generated a positive 1.25%. Why did we capture it for the portfolio? Because we give priority, or we rather consider only the benchmark return. Corresponding to that, what was the return of my portfolio? We just consider that. Now here as well, we take a CAGR of this data set, and that is how we arrive at this negative 26 and negative 31%. Now, what does this say? That when the benchmark fell by 31%, my portfolio fell only by 26%. So rather, this says how that my portfolio is resilient to the benchmark when the benchmark is in a bear run. And similarly, you just divide this 26 with that of 31 to arrive at this 83%. And for down capture ratios, we'll say lower the down capture ratio, better is the resilience of the portfolio against the benchmark when the benchmark was in a bear run. And by lower, I mean it should be lower than 100. Followed by that, we could see this monthly and yearly statistics. So right here, we could see 61 is something that has been mentioned. Now, this denotes that in this time duration of 5 years that is under consideration, there has been a total of 61 months, out of which 46 months my portfolio gave in an up performance and 15 months my portfolio gave in a down performance. Now, if we take a percentage of this 46 out of the 61, it comes up to be 75%, meaning 75% of times in this 5 years, my portfolio gave in an up performance, and 24% of times it gave in a down performance. You could also see which was the best return that was generated, 9.39. You can anytime view this on this graph. November 2020, the portfolio gave in the best performance, and the worst performance comes to be negative 22.55% in the month of March 2020. So basically the COVID time duration when the portfolio gave in the worst performance. Followed by that, we go to the contributions tab. So this tab basically lets us see how each fund individually contributes to generate portfolio return as a whole. So next to the name of the fund, you could see percentages. So these are basically the individual absolute returns generated by these funds in the time duration under consideration. Meaning for Motilal Mid Cap, 307 is the individual return generated by this fund in this time duration of 5 years. Now, based on its allocation in my portfolio, Motilal Oswal is allocated to an extent of 16.6. It is equally allocated portfolio. So based on this allocation, my portfolio contribution from this fund comes to be a total of 28%, of course, when we base it to 100%. So this tab basically lets you take in decision, or rather decision making is something that could be helped using this contribution tab. Let's say a specific fund is generating very least amount of individual return. You could rather take in decision to maybe completely remove it from your portfolio, or maybe reduce its weightage in your portfolio as well. Now, if we see that since this is an equally allocated portfolio, the best performing fund is only this Motilal Oswal Midcap. Rest are all the other funds, Nippon, Mirai Asset, and HDFC Focus 30. Although these have similar allocations in the portfolio, their return generation is not in comparison to that of Motilal Oswal Midcap Fund. So as I mentioned, decision making could be done using this contribution stack. Followed by that, we have this rolling stack, which basically lets you see the consistency of the portfolio. Now, when you analyze a portfolio, by default, 3 rolling windows is something that you could see. 260 equivalent to 1 year, 520 equivalent to 2 year, and 780 equivalent to 3 year. These are the scenarios that get created by default, but anytime you could edit them. These are editable. Input the data, meaning 260 into the number of years, you could change in the rolling window and simply click on run. And the data accordingly would show up for the rolling window that has been selected. Now, for a 260-day rolling window, you see the average return comes up to be 22.1%. Now, what does this say is that if I stay invested in this portfolio for any 1 year, any 260 days equivalent to 1 year, if I stay invested for any 1 year in this portfolio, from this start date of 16th July 2019 up until this end date 18 July 2024, for any 1 year, my average return would come up to be a total of 22.13%. Now, this is basically the average return. Let's say you rather want to see specific points return, meaning what would be the scenario or situation where you could have generated the highest return, which is right here. So this says 53.45, which is the highest return generated in a 260-day rolling window. And next to that is 22 March 2021. So this typically says that if an investor would have invested in this specific portfolio exactly 260 days prior to 22nd March 2021, their return generation would have been 53%, meaning they would have been the luckiest. The highest return was generated in that 260-day rolling period. Now, even if you look upon this lowest return, in a 260-day rolling window, the lowest return that was generated was a negative 6.13%. But as the rolling window kept on increasing, if you look upon a 780-day rolling window, even the lowest return that was generated was a positive 15.72%. Meaning this basically says that the more you stay invested into a mutual fund portfolio, the chances of generating a negative return reduces. So this was our rolling distribution tab, followed by the last tab being the scenarios tab. So this basically lets you create in customized scenarios of your own, meaning you want to see in a budget scenario or an election scenario, how did your portfolio perform? You could simply click on add custom scenario, give a name to the scenario. Let's say I rather want to look upon an year to date scenario. So I'll input a start date of Jan 2024 and the end date as yesterday's date. And click on Save Custom Scenario. So right here, my scenario has gotten saved. You could simply click on this and the scenario shows up. So blue line showing the performance of this portfolio and green line showing the performance of the benchmark, suggesting that in this year-to-date time duration, the portfolio has outperformed. Excess return is something that you could see to an extent of 8.84%. So such scenario situations lets you see how did the portfolio perform in the time duration that you have set it. Now, this was the portfolio analysis that we looked upon. Next are the reporting options. Firstly, being PDF. So this is a 4-page of PDF. The first page letting you see the performance, also mentioning what is the reference index and what does this compose of. Yearly statistics, the top holdings and the top exposures, the asset allocation, also letting you see the AMC exposure, which is the AMC that is heavily weighted towards your portfolio, followed by the equity market exposure and the debt market exposure. And lastly, the rolling returns and the drawdown tab, which lets you see how did the portfolio recover from any loss that happened. Now, this was basically a PDF that got generated. Next, what we have is basically a PPT, and we call this as an actionable proposal. Meaning, let's say this is a fresh proposal that you rather want to share with your client. So you can anytime create a percentage-based PowerPoint. And since, as I mentioned, that this is an actionable proposal, you could anytime create an amount-based PPT. Let's say your client's AUM is 15 lakh. I'll input that figure right here and I'll click on create PPT. So an amount based PPT will get generated on your end. So this would be the first page, followed by the second page. You see the amount of 15 lakh got distributed among the schemes based on its weightage. So amount that is invested into each scheme is something that you could see. Followed by the next page, letting you see the asset allocation of the entire portfolio, followed by the equity market exposure and debt market exposure. We saw the split in terms of large, mid, and small cap, which is the equity sector that is heavily weighted towards the portfolio, followed by the performance chart, letting you see how did the portfolio perform against that of the benchmark. Next being the rolling tab, and last is this drawdowns tab. Now, the feature of this PPT is that these PPTs are editable, meaning you could insert in multiple slides as well. Let's say I've added in this slide and I rather want to add in a scenario that I just created. So this is the scenario. You could anytime use this orange icon on the platform, which lets you take in screenshots of the tab. For now, I'm just using this snipping tool. I'll just copy this and this could be pasted as an image anytime. So in that way, it is very editable. So you can add in slides, remove in slides that you do not feel is important. So such additions is something that you can do. And also the another reporting option that is available is basically this share link. So once you click on that, certain options show up right here. First is meaning hide NGEN Fund Score. So these are the fund scores that would be visible once you use this share link. You have an option to do a tick on this checkbox. So these fund scores would be hidden. Next is this lock start and end date in share link. Once you click on that, the client who is looking upon this portfolio would not have an option to change the start and an end date. And also this link remains active for a total of 7 days, but you have an option to reduce the number of days. And you simply click on create. Now this link has gotten generated. Click on copy and you can open this in a new tab, meaning you can share this across with your client. So all the tabs that were visible to you will also be visible to your clients as well. Every tab that you see. And you could see that the NGEN Fund Score is something that is not visible. And also the option to change the start and end date is something that is not visible. And since I had selected that I want to share this for 5 years, the client who has this link will be able to see this only for 5 days from the day it has been shared across. So that is it for the topic related webinar. If anyone has any query, please either unmute yourself or you could type down your query in the chat box.
Hey, hi. This is Satish here.
Hello. Yes, please.
I have three queries, three doubts.
Yes.
The first one being when you said that the overlaps that which you were comparing, in that
Yes.
overlap, you also consider the traps and as well as the cache component, right?
Yes.
So can't we be able to remove that? Because see, when we look at overlaps, we are very particular about the stocks that which is getting overlapped.
Yes.
So is there any option that to remove it?
Okay, so typically, as of now, we do not have an option to remove traps because we consider all the entire underlying of a particular fund with that of the other. But sure, we will note this down as a feedback. In fact, this was raised a couple of weeks ago by a couple of our users. We have noted that down. We will check if that's possible to turn that off for typically and rather limit it to mutual funds stock holdings only. But we'll have to discuss on this. We'll note this down as a feedback.
The reason
Yeah,
why
hi, this is Arunab. Yeah, this
Hello?
is definitely possible. In fact, let's put this down on the list. We'll take out all the cash components, etc., out of it. We'll only look at direct equity or even bond positions only.
Yeah, Arnab, there is a logic behind it. The reason why I am highlighting is that, see, if
Yeah.
you have too many funds to check on the overlaps, we don't go each and every fund to check what is the overlap. So sometimes the color coding that which you are given very useful. So we'll just go by that. So instead of going each and every rows, it will be easy if you remove the traps and then cache orders, because sometimes it might mislead if you look at only the graph and then move on to it.
No, fair enough. Fair enough. We'll remove all the cash portions. So we will only consider anything that's a stock or an actual debt security.
Exactly.
Yeah, fair enough. Fair
And
enough.
the second query is on the up capture and then down capture. Can you go to that tab?
Yes. Yes.
So here, can you click on it? Yeah.
Yes.
See, you are saying the monthly returns. This is a absolute return from first of the month and then end of the month. Is that right?
That is correct.
Yes.
Oh, okay. So this is the monthly return of that particular portfolio.
Yes, that's correct.
Okay. Yeah. Okay. Right. The third one is see, when you give the portfolio in totality, I could able to see somewhere you have given a weighted TER as well. So can you
Yes.
able to give us the weighted P and then price to book of this portfolio only for equities?
Yes, we can do that. I guess the only kind of point where we have to just look at is, like, for example, if you have a fund with have a portfolio with, let's say, 4 equity funds and 1 debt fund. So when we calculate the weighted PE, do we calculate only the portion of your portfolio that is in equity funds? Or otherwise it'll get value. Obviously, debt funds won't have any numbers. So
Exactly. Exactly.
yes. So I mean, it's a question of we can actually probably show you in both methods. Yeah, that this can be done. This can be done. Let's just write this down so we can add it to the next release.
Yeah, see,
All
the
right,
point,
sir.
most of this comparisons that what we are doing currently when we construct this portfolio is a past performance. When we want to look at something for the future, when you looking at this P and then PB, at least we come to know the stocks that what we hold in the portfolio, the valuation of those stocks. So all the portfolio as such. So that will give you some forward-looking aspect to the portfolio as well.
Fair enough. Fair enough.
And there is one more query. the rolling return that what we are taking. Can you go to the rolling return tab?
Yes.
Yeah. See, how do you read this absolute? Like it's absolute return and then annualized return. Can you just toggle between these two?
Sure. So
Yeah.
typically, in this case, as you can see, when the holding period, right, is 260, nothing will typically change between absolute and annualized for 260 column, right? 260 is equivalent to 1 year in terms of working days, right? Only when we increase the holding period or rolling window to a 2 year period, or for that matter, any period that is less than a year, only that time should you be in fact concerned about annualized or absolute. So for an example, in this case, when it is absolute, average return, average rolling return for a 2 year period, 520-day time period, is a 43%. Now that is for the entire point to point for 2 years period. Meaning if you simply turn this blue line off and the first point that you see on this green line chart, that's 28% if an investor stays invested exactly 2 years prior to 31st of May 2021. Now, this 28 returns a cumulative return for 2 years, which if you change it to annualized, it will definitely change to a period divided by 28 divided by 2 almost, right? So it will be something like a 14%, right?
Okay. Okay. So when you say it's an average, right? Then
Yes, yes. The average rolling return that you see here is basically a average of all of these points taken together. Average that you see here at 260 is an average of all the points that you see on the blue line.
okay.
Yeah.
Fair enough. Thank you.
All right.
Hello.
Yes.
My question is with regarding to the engine score.
Yes.
As you have told that the engine score give the weightage of the age of that particular mutual fund. And what is the weightage of age in this engine score of a particular mutual fund? Like you have
Uh,
taken a qualitative and quantitative criteria.
yes.
For
Yes.
qualitative criteria, what is the weightage of age?
Okay. Okay. Understood. Okay. So age is just a parameter that is used to give. In fact, what happens is age is not given a percentage. That's because it's a qualitative parameter. The allocation, the combination is only given to AUM and the short, medium, and long term returns and volatility. 10% is to AUM and the balance 90% in equal proportion. So 30% goes to short, 30% goes to medium, and the balance 30% goes to long term returns and volatility. That is risk adjusted returns, right? Age as such does not get a weightage, but because if there are any younger funds, they will default be given lower fund scores till the time they complete 5 years into existence. Meaning, in other words, you can say that the younger funds will have a disadvantage over the funds who are 5 years or older. The moment they complete 5 years into existence, this disadvantage due to age will stop being given to them and they will be ranked pari passu with all the other funds that are 5 years or older. Now, in other words, we can also say that a fund which is just 6 year old will not be given any disadvantage um, as compared to a fund which is, let's say, 20-year-old fund or a 28-year-old fund. No disadvantage will be given, and that's why we consider age as a qualitative parameter which will be having its impact only until the time period of 5 years is not elapsed from the time the fund has actually launched, right?
But don't you think the fund which is like a 3 year old can give some like good returns as compared to the fund that is of 10-year-old? But according
Yes.
to the engine score,
Yeah, no, you're absolutely right. A 3-year-old fund can also perform very well. So the only issue is that with the fund score, we're not telling you which fund is going to perform well. Obviously, it's a historical measure, just like any other measure. But the main point here is that something that has not got at least 5 years of full performance gets scored a bit lower, because the issue is that it is unfair to say, it would technically be unfair to say that a 3-year-old fund is as good as a 6-year-old fund, because a 6-year-old fund has obviously been through various different market conditions that a 3-year-old fund has not. So it is not to say that the 3-year-old fund is worse, but the problem is we don't have any metrics to judge the 3-year-old fund with. We only have 3 years of data. So even though it may be even unfair to the 3-year-old fund, there is no other way, because so what happens is, if a fund has only 3 years performance, it will get a proper score based on its, let's say, 1-year return. It'll also get a proper score based on its 3-year return, but we cannot give it a proper score for 5 years. So we give it a neutral score, so it's ranked right between 0 and 10 in the 5 range. Now if there is a fund that is going for 6 years and has excellent performance for 5 years, that fund will get an advantage over this fund. So when they don't have long-term performance, we give it a neutral rating, because we don't know whether it would have done well or badly. So that's the only reason that a 3-year-old fund will get a slight disadvantage compared to a 6-year-old fund. It's only because the 6-year-old fund just has more proven data. That's the only reason behind it.
Okay. Thank you.
Arnab, I have one more question. Can I go ahead?
Please.
Arnab, in fact, in some other interaction with you, I have raised this as well. See, when you want to send maybe information about a SIP, so the issue is that we are giving only the graph in that SIP PDF that which we are having. If we can able to add some basic details about the fund, it will be great. So just generate a PDF. No? Go down. This is what the PDF.
Right. Okay. Yeah.
So you understand what I'm saying?
Yes, of course, you're right. It's just the name of the fund.
Yeah.
And if you want to give any other information, then you have to print
Not
out
this.
the other one.
Yeah, I have to go for another PDF. So where I will be sending 2 different PDFs. That sometimes the client will
Understand.
get what is this?
Understand. That makes sense. Prajakta, let's write this down so obviously we will do this for only funds. And for mutual funds, we will basically, put more fund details in there as well.
Exactly. So
Okay.
see, basically we don't need this monthly SIP breakdown. If at all somebody who needs, you can give that as an additional option, because this is just a data that which we are giving. So the client is more focused on what kind of a portfolio that I am going to invest. If I invest in that portfolio through SIP, what is going to be my return? That's what the client is looking for. So he is not looking
Right.
at the NAV on a particular day when I do for the last 3 years or 5 years. That's none of his business, because he is looking at in totality. So he don't go minuscule into those kind of details.
Understand.
So if you can able to implement this also in your upcoming changes, it will be very great. Because this is
So you're talking about a portfolio SIP analysis, right?
no. This particular
Right.
fund analysis, I'm saying.
Yeah. So we will definitely do this, because as you're quite rightly said, in this particular document, it just says SBI Small Cap Fund and nothing else.
Yes.
So
I need at least
so
the top 10
yeah.
holdings.
Okay, fine, fair enough. Okay, so some basic fund details, like what the holdings are.
Who's the fund manager,
Basic.
and
Yeah,
then
exactly.
what is the sectoral
Yeah,
exposure, if possible, the top 5 sectors. See, what I'm saying
fair
is
enough.
you have to club
Yeah.
2 things. One is the fund detail fund card that which you give, and then the SIP
Yeah.
return. Nothing else. You have to club these 2
Yeah,
things.
we can put that together. Yeah, fair enough. Yeah.
Arnab, you can do for
That's
the
fair.
portfolio as well.
So portfolio SIP, see, we have discussed this also. We are happy to do it. It's just, as far as all our users understand, is that when we do a portfolio SIP, what it will do is, if you look at this portfolio, for example, it
Right.
will take this blue line that has already been generated, right? And
Right.
it will run the SIP analysis on this line, right? On
Okay.
this index, basically, which has been created with using a backtested funds. Now, in reality, if you had done this SIP, the results would look slightly different because obviously you can see there's 16.67% weightage on each fund. Now you put a, you put a, 10,000 rupees on this, then you have exactly the amounts here. Next month, when you put 10,000 rupees, they will be distributed slightly differently and so on. And when you do that, over your overall position in each funds, in terms of whatever you've gathered up till now with the SIP entries, may not match exactly this weightages. So you'll have to rebalance them as well. So
See,
all I'm
if
trying to
you
point
if you
out
do
here is,
if you do
yeah,
SIP for 3 years, or you put
yeah,
lump sum into this, keeping
yeah,
it market moves in same tandem it was, you will
yeah,
hardly find 3 and 4% difference, not more than that.
yeah. Fair enough.
That, that, that is
That's
that is on
all
the higher
the.
side I'm talking about.
Okay, fine. So what we will do is we can this. In fact, I think last week only, Prajakta, if you remember, we did put this into our list, right? So
Yes.
we will come up with a new tab which will run the SIP on this line, and we'll put a little disclaimer that there will be certain differences from from rebalancing issues for especially for SIPs in portfolios.
Yeah,
But yeah,
because
we can be able to create.
which is very relevant, because you
Yeah,
can't run on, if I start SIP on some particular day, and if I
yeah,
start, because you can't do SIP on daily basis, you can't map the
yeah,
data, so there will be
yeah.
difference.
Yeah,
Maybe
yeah.
somebody will
But you
force
will
you to,
still get a general. You'll still get a good general
but
idea
still
of
it
what
will
will
give
come.
a good input to understand
Yes, yes.
that how the portfolio will behave. 1 or 2
Correct. That's
percent
right.
is immaterial
Fair
over a
enough.
period
Fair
of three
enough.
or 5 years. 1 2%, 3 4% is immaterial.
Fair enough. No, so this will definitely be done. In fact, this is already on the list. So it's good that we have spoken about it. So this will definitely come.
Thank you.
Yeah.
There is another question in the chat box which says, is the overlap only between two funds and not all funds in the portfolio? No, in fact, it is between every fund of the portfolio with every other fund, right? It's a metric structure. The moment you hover on a particular cell on the overlaps tab, two funds will get highlighted, right? On the left hand side, meaning on the row, HDFC Focus 30 is the row that we are currently on. So that is the first fund. And the second fund will appear at the top as a column heading. So that's Nippon and HDFC now. You click on that 21% and it will show you the overlaps between these two funds. Now, hypotheticals, or for that matter, in any scenario, if there's one particular stock that is common across all of these funds taken together, for an example, there's this ICICI Bank, which is held by every single fund that we are currently analyzing, only then that stock will appear right here. So that which says, okay, this shows minimum common holdings across all of these funds. Currently, there is not a single stock which is common across every fund that we are currently considering. Therefore, we see no positions common across all funds, right? But typically, it's always within a pair of funds, between a pair of funds, always.
There is one more query here. Arnab, probably you can able to answer this. See, in this overlap tab, can we have a functionality if at all we don't want compare a particular scheme with the rest of the schemes? Is there any possibility?
You want to remove um,
Yes.
something from this list?
No, I don't want to remove from the list. I'm saying here in this particular tab, if I click on it, see the way in which you show in the graph, if you click on it, it will go up. If you click on it again, it will come back, right? So
Yes.
can we have some functionality? Because see here, it doesn't make sense to compare a debt fund with a equity fund.
That's right. Yeah.
Right. So if I click on the debt fund, so it should deactivate. It will compare with the rest of the schemes.
Oh, I see. You want to remove. You want to temporarily remove
Yes, exactly.
an item from this list, basically.
Correct.
Okay.
Yeah, like this.
Yeah, I don't see why not.
Yeah, something like this.
Yeah, exactly
Yeah,
something
yeah.
like this.
Oh, so leave it with us. We will try our best. We just have to check a few things, because I'm pretty sure it should be possible. But we will try it. So, Pradakta, let's write this down. So we will try to get this done. Maybe check boxes or something like that.
Yeah, yeah.
Thank you.
Thank you.
There's another question in the chat box which asks, how do we calculate Sharpe ratio of selected funds from a particular date? Okay, so typically if you want to calculate Sharpe ratios, you simply take all of these components to the compare section. I'm talking about fund level, right? So you take these funds in the compare section, you put in a start date right here. So let's say you want to have Sharpe ratios of all of these funds, let's say for the last 1 year, right? So you change the start date to 2023, let's say 3rd of July onwards, and then you hit on go. When you do that, it will say a prompt that, okay, there's a custom start date that is chosen, and the Sharpe ratio numbers that will appear here will be for the last 1 year time period that is being considered. Right? So typically change the start date here, and you should get the updated Sharpe ratios as per the time period that is chosen. Again, if you do not want the entire clutter of all of these columns, you definitely have an option to pick and choose what you need. So let's say, you just need the NAVs and let's say the Sharpe ratios. That's it. So you can pick and choose what all you want as these columns. And then you can, of course, take Excel downloads if required. There's another question in the chat box which asks, for NGEN Fund Score specifically, do the weightage keep reducing as the fund ages from 1 year to 5 years?
Sure. So, no, the weight doesn't reduce. So, for example, if a 30% weightage applies to the 5-year return, for example, a fund that is 4 years old will just get a neutral rating for the 5-year period. And for a fund that is more than 5 years old, they will get a proper rating for whatever their performance is for the 5 years. So we don't readjust the weightages just because a fund isn't old enough. So the weightages are constant. In fact, this is one of the things that we have decided to do, is that we are not changing our scoring methodology based on the type of fund. If it's a small cap fund, large cap fund, or value fund, we are using the same consistent methodology to rate every fund. So there is some sense to the actual rating process. If we start to tailor every rating process to every type of fund, then that becomes much more of a kind of opposite situation where we're basically chasing our own tails because we're trying to fit something that works. And effectively, you will just basically come back to looking at returns within the category. So this method is exactly the same no matter what kind of fund it is, and it applies across every fund.
There's another question in the chat box which asks, dear team, can we import client's MF portfolio direct plan from IFA now and generate portfolio analytics report? So no, currently no onboarding options right now that you will see on the platform typically to onboard a client's portfolio is using this statement analyzer that you will see at the top. In launch tools at the top, there's the static launch tools. It's always there, irrespective of which tab you're on. You click on this, it lets you onboard NSDL, CDSL, or CAMS, ECAS files of the clients. Now, that could be, direct or regular files. I mean, that doesn't matter. Direct funds or regular, right? Once you have that file, you put in the file password, which is generally the PAN number, and the file will get processed like this and it will appear on the right hand side. Once it appears, you click on the see holdings icon and you'll be able to see all of the holdings. From the NSDL CDSL, it captures stocks plus mutual funds, right? And that is how you can onboard using a statement analyzer tool. We have a couple of more portfolio onboarding options, which is typically if you choose to upload using ISIN numbers, right? So for that, again, you go to the portfolio section, you click on this add a new portfolio icon and load ISINs. You just need two columns from an Excel sheet. One will be ISIN numbers. The second could be either percentage or amount or units per shares, or units or shares. And then you ask the system to read it as what it is. and the portfolio will get created. This is the second portfolio onboarding option. And the third and the last one is, of course, manually. So you click on a plus icon and you add the holdings of the portfolio one by one. This is for all of your prospectives. If you're looking for existing, of course, we have the RTA connection, which will let you onboard all of your ARN or RIA code clients onto NGEN Markets platform.
One more thing to add here is we have a connection with a back office software called Fund Expert. So if you are a Fund Expert customer, all your holdings, latest holdings will automatically be synced from there overnight. And if you are with a different back office provider like IFA Now, etc., that you mentioned, if your back office is willing to integrate with NGEN, then we are happy to do it. So if you do have some contacts, let us know and we can speak to them. As of now, if you're a Fund Expert customer, then all your data will come in here directly. If you're interested in subscribing to Fund Expert, which is a separate company, you can just get in touch with us. We have some special pricing with them.
Okay, there's another question which asks, do we have an option to calculate quarterly or yearly SIP return? So
So we have
we have
we have
monthly
the
SIP.
SIP. Yeah, we have the so yeah, we currently only our system's currently showing only monthly. We can look into this. As of now, we don't have this on our list, but we will investigate the option. Prajakta actually just put this in because we can look into this.
Yes.
Any other questions? Please let us know.
By the way, are we done with this actionable, this one, like uh, generating actionable proposals? That's done?
Sorry, which one do you mean exactly?
Now, in today's discussion, we had
Yeah.
the last point is actionable, generating actionable proposals. Was that done?
Yes, yes.
Yeah.
So we did discuss in the webinar, right? So
Yeah, yeah.
typically we went to the portfolios tab and we explored these
Oh, that's the one.
PPT options.
Okay, okay.
Yes, those are the actionable proposals. If you put that in rupee terms, that gets generated as a proposal. So that's what we covered. Also the share link.
Okay, if there's nothing else, Prajakta, we can close for today.
Yes. So thank you everyone for joining in. You can definitely refer to our past webinar recordings by visiting our YouTube channel. There's a dedicated playlist that is created for all the webinar recordings. You'll find that right here in the playlist option. 120 videos already uploaded. This week's webinar recording will also be uploaded by the next week. Till then, do stay tuned. We'll definitely come up with a new and interesting topic next week. Have a great weekend ahead. Thank you for joining again.